for joining us. My name is Jani. I'm with the Vancouver Startup Week team. I'd just like to take a moment to acknowledge that we are grateful to be virtually gathered on Indigenous land, regardless of where you're joining us from. I am grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples. I'm privileged to live, work, and play on these lands. First of all, I'd like to thank you all for joining VSW 2021 and welcome to Meet Vancouver's Angels and VC Funds hosted by SFU VentureLabs. This session is part of the VSW Growth Track and is proudly supported by Innovate BC. Innovate BC is a Crown agency that provides small businesses around the province with funding, business coaching, and educational content. They're helping entrepreneurs and founders start and scale their businesses and adapt to the changes brought on by COVID-19. If you're looking for support for your business, make sure to stop by their booth and learn more about how they can help. I'd also like to take a moment to thank SFU VentureLabs for being an event partner and also a sponsor. VSW could not happen without the continuous support of our community sponsors. So without further ado, if the audience has any questions for our speakers, please do post them in the Q&A in the Whova session. You can also upvote those questions. So I'll now pass the mic over to our speakers, and thank you.
All right, thank you very much, ladies and gentlemen. My name is Dave Thomas. I'm the moderator for today's session, and I've just shared my screen. I'm going to just have 2 slides, and hopefully we'll be able to look at them as full screen. So today, I've got a really good group of early stage investors from British Columbia. Very pleased to have a whole series of folks with us. I'm going to ask them to do an introduction of themselves as they sort of answer the first question in a series of questions that I have. We'll do that as the first part of the session. Our goal today is to look at examples of recent financings. Quite often everybody says, these are my criteria, this is what I'd like to do, but often the best example is a really good indication of what's important and what's hot and what's happening in the early stage financing market. So this is who's online. We have Thelza Lee, Hans Knapp, Jason Neal, Mike Volker, Irene Dorsman, and Kaylin Pepin. Just before we get going, I would like to mention that VentureLabs has 2 other webinars at Vancouver Startup Week. One is about going global. That's with the Canadian Trade Commissioners tomorrow, 11:30 to 12:30. And then we have a second one on Friday, which is setting up your health tech startup for success. Again, 11:30 to 12:30. And it's something which targets digital health companies, ones that are interested in health tech startups. And finally, next week, for those that are interested, there's a webinar that we're working on in conjunction with NRC IRAP, and it's accessing non-dilutive funding. In other words, understanding what type of funding is available and what the criteria are. So as we go ahead, and that one is one where you can register through the VentureLabs website if you'd like to do that. So what I'd like to do now is just start in with some of the questions that I have, and I'm going to ask each of our panelists to give us a very quick 2 to 3 minutes on example of a recently funded company. And I'm going to go to Thelza first and ask Thelza to do a very brief introduction of herself and then give us an example or 2.
Great. Thanks, Dave. This is really great to be here with everybody. So my name is Thelza Lee, and I've been working with Mike Volker, who's also on this panel, on the Vantech Angel Network. It's been around for a couple of decades now, and we've been having a number of entrepreneurs being funded by investors who meet every single month to view these awesome ventures. And the Vantech members are, individual angel investors, and they're also funds. And I'm here to also represent eFund, which is one of the active angel investment funds in the area. One of our most recent investments was in Lucent Biosciences. So, people say, well, what criteria do we look at? I really put things into 4 buckets. I mean, is there a real problem that they're solving, and what's their solution? And those are really quickly dispensed with when you've got, okay, they prove that their solution works as advertised. But what really seals the deal for me is, are they the team? Are they the company? Are they the ones that actually will provide a solution that will, transform an entire industry or entire way of doing business, entire way of solving a problem that will actually solve the problem and give some benefit to society and give us investors a great return. So the final thing is what is it that we can do as investors to help them along on their path. So when we were looking at Lucent, I would have to say when I saw Lucent, they had a really interesting technology, but it really felt to me like it was a technology looking for a market. That all changed last year, and they really de-risked their project by securing some major customers who are actually global leaders in their industry. And they may have struggled, but once they secured those customers, then that really did it for us at eFund. Everything was in place in March 2020. They did some meaningful trials in summer 2020 that just, again, proving their technology works, proving that their product actually solved a problem, and that they had global customers who were really interested in them. And remember, I said that other factors that had to happen to make us really sit up in attention. So their product worked as advertised. They got their customers, but the team was really great. The CEO was a serial entrepreneur, has a solid group of people working with them, protected IP, huge market, clean and environmentally friendly company and products. They ticked all the boxes. So, even though it was a long commercialization cycle for this company, we were really confident in them. And when we asked them, the fourth bucket, what can we do as angel investors to help them achieve their goals? And so we were very proud of being one of the investors in Lucent Biosciences. So we're looking for great things from them. They've been doing they kept on their trajectory. They added two very experienced agri-food guys on their board and on their team, one from Monsanto. I'm sure everybody's heard of Monsanto. And so we're looking forward to some great things from them.
Okay, good. Don't want to cut you off, Fazal, but I will. I'd like to try to keep everybody to about 3 minutes or so. I'm going to go to Hans as our second speaker. And Hans wears two hats, both as an angel investor and also as a well-known venture capitalist in town. And maybe you could speak a little bit to Yaletown Venture Partners and give us an example, please.
Sure. So, on the fund side, I represent as one of the co-founders of Yaletown, a fund that's been around for over 20 years now. So we're typically a Series A investor, investing in companies that generally are at around the 5 million in revenue stage, and have got a couple of dozen investments in Western Canada, including lots here in British Columbia. In addition, I do take a look at and with the proceeds of the DEA exit from years ago, now do a number of investments in other technology startups that are not in the same space as where our fund invests. And the example I'm going to give today is a company that's known to a couple of the other panelists. They recently completed a $4 million safe note financing. The company is called Cubo. They're based in Victoria. I'm generally not a huge fan of safe notes because for those of you that have heard me speak about this publicly, I tend to refer them as situations where people are in valuation denial. And but this is one case where I think the use of the instrument was probably the right move, given the stage of the company's development and where the safe will get them. So as I mentioned, it was a $4 million safe note. I'm not going to go into the terms too much, other than if you take a look at the company's trajectory, the company was trying to get or looking to get an A round completed earlier this year. And given their revenue traction, they're growing at north of 100% year over year. But at the time they were looking to do the financing, they were running at around 1.6 to 1.8 million was kind of their annualized revenue trajectory. And the feedback from the Series A investors was reasonable, but not great in terms of what the valuation compared to the valuation aspirations for the company. This is a company that's growing 50% every 90 days. Okay. and has great sort of revenue retention and churn and other metrics. So they said, "Paul, you know what? We'll just go raise some money based on a safe note that's got a reasonable discount looking forward. With this capital, they will comfortably get to 5.5 to 6 million of ARR. That will amply equip them to do a Series A at a valuation that, even if it's on the sort of the average level of multiples, is going to be well above anything they were offered in Q4 last year. So, and it's minimally dilutive given that it's 4 million compared to the roughly 10 million of Series A money that they would have been looking for. So yeah, it's a good example. It's a company that's grown tremendously over the last 2.5 years. They have an international client base, and are looking to more than double their team here, with the majority of that in sales over the next kind of 12 to 18 months. So I think a very interesting company to watch in a space where there is going to be consolidation, and I think this will position them well for it. So it's one of those few cases where the right instrument at the right time, but it's not a situation where I'd advise everybody to go out there to go start doing safes. They do have some drawbacks too for investors. So that's the kind of the quick and dirty summary on that, and look forward to taking any questions, but as well as talk about some of the other details later on.
Okay, Hans, thank you very much. Much appreciated. A slightly farther along company with a larger raise, and you can see slight differences in the structure of the deal and also the trajectory of the company. I'd like to change gears a little bit and ask Kalen Pepin to speak right now. And Kalen is with BDC, but he's in a different part of BDC than we're normally used to hearing from. But at the same time, more and more active in the marketplace. So Kalen, please introduce yourself and what you're doing.
Yeah, thanks, Dave. Yeah, that's a great intro to go into. Is BDC is an extremely active investor in the Canadian tech ecosystem across different ranges like equity. The group that I specifically work in is debt. We do a lot of early kind of growth stage for scaling tech companies. We'll do some loans in it, not to a pure startup. It needs to have angel or has to be built off of equity. But typically, once they start to see some traction, that's where we can come in. My group's job is also to help navigate the bank. Like, we have some new funds. We have an IP fund that's just started. Actually, they've been around a little while now, but a deep tech fund that's just started as well. Another growth equity fund that was announced. But where my group comes in is we're typically doing these growth stage companies. So usually what you want to have is you want to have an MVP in the market and get some traction, have some revenue generating activities that are identified. And those are kind of nice things to fund with debt. The big draw being that it's non-dilutive, that you don't have to go through the raise at the time or take on like the safe note necessarily. So the company that I wanted to have a look at is in Victoria as well. This is one that we did during COVID, and it's called Peloton Technologies. It's a financial technology company, based in Victoria, kind of a cash management platform for businesses to manage all of their accounts, all their transactions across different banks. The market trend during COVID, on my portfolio, I saw something very interesting. I'm sure others saw it too, where tech really had a chance to shine during COVID, and a lot of the software companies took off. Some that were related to industries hit by COVID, like travel tech, struggled, but others, it was really a chance to shine, and Peloton was one of those. So we did a $350,000 term loan with a 1-year interest only period at the beginning. And it was part of a $500,000 marketing project that $150,000 was funded by the owners themselves. And the funding was for sales and marketing. So that's something really important to us, is that it's revenue generating activities. We rarely want to see it going to product development, or usually want to see the tech risks off the table. I mean, you're going to continue to develop your tech consistently as a tech startup, but we want to see that it's in the market and that it is working. So this company really liked the management team. They had a lot of customers. They were around 800 with organic growth. So they hadn't really hired that sales development rep or poured that money into marketing yet. A lot of it was coming word of mouth, or when a payment was being sent on the email, it would have the name and others would start using it. And then they had a realistic marketing plan that they wanted to execute on. So we felt this was a really good fit for a debt financing instrument. And the hope is that this money is then used to really boost those revenues and can get them to another raise, maybe can bridge them to that Series A with a higher valuation, and without having to dilute. We also turned this could turn around in 3 weeks. We did this loan from the time we met to the time it was due diligence and turned around. So it could be a nice option when there's a marketing plan on the table that you'd like to execute on quickly.
All right, super. Thank you very much, Kalen. And I have to congratulate Kalen on having a nautical chart in the background while he's speaking. It's always good to see people who are boaters and sailors participating in all sorts of different things. So that's great. What I'd like to do now is ask Jason to speak. And I believe Jason is a non-Vancouverite, and his fund is from the Okanagan and also from Alberta. So maybe, Jason, you could explain a little bit about where you come from and then carry on after that.
Yeah, sure. So actually, we're based out of Calgary, although I do live in the Okanagan. So no apologies for that. And I have to say, I like the note about safe for people not knowing what their valuation is. I thought that was quite funny. So I've got a couple of charts. I'll go through those quickly just to talk about a recent investment that we did. So let me share a screen. You can all see that, I guess. So recently we did an investment into VentureLabs, and I think this will probably be useful for everyone, myself included. So they do custom supplements for wellness brands after personal testing. So basically you have a personal test about yourself. You might find that you have an iron deficiency or a vitamin C deficiency, and they will mix and match a supplement for you using high quality ingredients. Importantly, no FDA approval, so no regulatory approval required for this. They had and they still do a pretty extensive channel to market via testing companies. So everyone who does a test for whatever reason would have access to this, as well as practitioner clinics. And really low churn. I think low churn was mentioned by one of the other speakers, and this was obviously important to us. So you sign on to these wellness ingredients and really low churn. What did the deal look like? So it was a pre-money valuation of just under 10 million, post-money of 11 million. In the year that we invested, they had revenues of just over 1.1 million. So it was an 8.23 to 9.49 multiple. And they had a projection of 2.8 million. I think they've actually exceeded that projection in the second year, or are on track to proceed. This is the second year now. Gross profit of 784K. So, pretty nice company. We did about 250,000 in this in equity, and we provided a similar amount of debt as well. The minimum investment was 50,000. There were warrants of 1 additional share per 10 shares, and some obviously liquidation preferences and things like that. Other terms and conditions are up there. And what made them a really interesting investment? My number one criteria for investing, and I think it's pretty consistent across our fund, is the management team. So, do you have people that you think can execute on a plan? Because ultimately, plans never work out the way that you imagine. Things always change and happen, and if you have good people that have a strong business and an ability to react and grow, I think that's really important. My second major reason for investing is revenue. I think it's really fundamentally important that someone's actually given you cash for your product, because that's a transitional effect. It's no longer an idea or a piece of tech. Someone has actually paid money for something. I think those would be our two strongest reasons. Also, we look for some competitive edge, a well thought out plan, sufficient funding, including us, and an exit plan. Okay, I'll stop sharing now.
Great. Jason, thank you very much. Really interesting to see how it's a company that is a little bit different than some of the other B2B investors would be investing in. So more of a B2C play. And that's something that's nice to see in the BC ecosystem. Something
Yeah, I
really
think they have the Toronto Maple Leafs as a customer. And obviously Toronto Maple Leafs are winning now, so maybe the tech works.
Okay, well, you know, it's a once in a lifetime event for the Leafs. Here we are. What can we say? Thank you. I'd like to ask Irene Dorsman to give us another example. And Irene is with the Angel Forum. Maybe you can introduce Angel Forum yourself and talk about a company for us.
Yeah, I've just decided I'm going to change the angle a little bit. My name is Irene Dorsman. I'm involved in the Angel Forum, has been around for a long time. Basically what we do, we introduce very promising companies to accredited investors. We're a membership-based organization. And I like to think we're pretty strong in the educational part of investors and entrepreneurs as well. The way I'm going to change my my sort of talk right now is that something just really struck me, and that is that we all know each other here on the call, and the deals that actually were discussed, we all are in whatever way or whichever way involved in. There's Kubo. Kubo presented at Angel Forum as well. Event is an investor. We know Hans quite well. Then we have Vitamin Lab that Jason just spoke about. Event is a investor in that as well. They also presented at Angel Forum. So this is sort of what I would like to illustrate, like how this system works together. It's an ecosystem, different players, but one way or another, we always come across. So always keep that in mind when you are starting to work on a financing, it's relationship building. And please do realize we all know each other and we all ask each other for advice. So here we are. I wanted to talk a little bit about Lucent as well, because a lot of people here are involved in Lucent. They basically presented at Angel Forum based on the relationship that we built with the founder over many years. It's a slightly, as Stelzel said, a slightly different deal that we usually look at. It's there are few uncertainties, but based on the founder and sort of the area, the AgTech space they were in, they're producer of micronutrients, nutrients, fertilizer, and they recycle basically what you could say low fiber byproduct from pea and lentil hulls. So food processors are one of their big clients. And there's one party I left out that you will hear from as well. That's Mike Volker and Votiv. He has been involved in all these deals as well. What happened then is that we sort of got together, like we like to deal, individual investors from our group like the deal. We got Event involved. I think we're even sort of Lucent might be talking to OKR Financial as well for debt financing. So this is what I just really want to stress here. It's relationship building. You have to have your ducks in place as a founder. But if things look good and promising, there's the system and the ecosystem backing you up.
All right. Thank you very much, Irene. Slightly different take, but a very important comment on the ecosystem aspect of how everything works. So I'm going to go to Mike Volker as our last speaker. I'll just make two comments first. One is I have to disclose that I am an investor in the Voyageur fund that Mike runs. So I think everybody should know that. And because everybody else has spoken about Lucent, I hope that you don't do that. Okay, can you give us another example? Would be much appreciated if you're able to talk about another company for us.
Sure, thanks, Dave. Well, I won't speak about Lucent, but we did invest in Lucent, and we also invested in some of the other companies that were mentioned, like Vitamin Labs, for example. So What If is an early stage angel fund. The investors in What If are basically angels. And just this month, as a matter of fact, we've raised another almost $2 million from local angels. So we've got some cash on hand now for doing more investments. And for the last 3 years, we've been doing about 2 startup investments per month. And I see that trend continuing for at least the next year or two. you know, I started off with angel investing about, well, golly, 40 years ago now, and have been doing it ever since the early 80s when I sold my first company, which was a video display terminals company. But what I want to talk about, and it has to do partly with the high valuations that we're seeing now. There's a recent article that I would refer you to by Thomas Tungas of Redpoint Venture Capital. And he did a little study on this. And the bottom line is that the valuations have basically tripled from 2010 to now. And so because of the high valuations, it's making it a little bit more challenging for angel investors and angel funds especially to get deals done, because even though the entry valuations are higher, the question is, will the exit valuations follow suit and also be higher? So my problem when it comes to investing is I like a lot of companies and I love early stage deals and I want to invest in them. But what often holds me back is the wrong terms, or terms that are just difficult to swallow. I want to follow on with an example using Vantech, a company that has bone regeneration technology, founded by a Professor Bob Young at Simon Fraser University. And as Hans mentioned, this company wanted to use a safe. And I especially really don't like safes, because with a safe as an investor, you are a nobody. You have no rights, you have nothing. For the company, of course, safes are really good. But for many investors, they're a turnoff. And I know that in the US and Canada, many angel investors are really shunning the idea of safes. So what I'd like to propose and suggest to entrepreneurs thinking about using safes is an alternative. And I call that a safety. And if you go to the What If website, you can read a little blog on that. A safety is basically a simple agreement for future equity, but it's done today. So a bit of a contradiction in terms there, but instead of waiting and making a conversion down the road, what I'm suggesting is that you enter into a regular subscription agreement, let's say for common shares. Most companies already have a common share subscription on the shelf or can get one very quickly. And then you simply add a clause or two to that agreement, which has almost the same terms in it as a safe agreement does. So for example, what we did with Vantech, which had an $8 million valuation and a 20% discount on a Series A, we said, well, look, we'll just buy common shares right now, today, at the high valuation, at the valuation cap of 8 million. So we'll buy those common shares. And then when there's a Series A round done, then we'll make a conversion under exactly the same way it would happen as if it were a safe. And that worked beautifully. There was no pushback from the company in doing that. And it gave the company what it wanted, which is really deferring the whole question about valuation, but it gave us something. It gave us common shares rather than absolutely nothing. And I would stress again that a safe gives you, as an investor, virtually nothing. The last comment I'd make on safes, and then I'll let it go, is that we have done a few safes, and we have done them in situations where there is a reliance on trust. And Irene and Dave, you mentioned the community work and how we work together and often co-invest in deals. And so if I see somebody leading a deal whom I trust and it's a safe, then I might go along with it. But believe me, it's very, very difficult to invest in a company that is virtually unknown without that trust factor, because you are entirely trusting the company and the directors of that company to do what's right. So it's a big risk for investors. So I think on that note, I'll pause and turn it back to you, Dave.
Hey, thank you very much, Mike. Very interesting to hear the alternate approach, and one that seems to resonate. I see people nodding their heads. So that's a very interesting comment and much appreciated. Just a note for everybody who's in the audience, we will go to Q&A later in the session. Before we get there, I have 3 questions that I sort of primed everybody who's on the call with a little bit in advance. The sort of top 1 to 2 items for making a company attractive or unattractive. So we've heard a lot about the attractive things like team, proof, growth, plan, revenue, all those sorts of things. I wondered if we could start off with something other than a safe as a negative. What are the other things that make it less compelling for you to invest in a company, if you want to put it that way? Who'd like to go first? Is anybody who wants to put their hand up? You're all being too nice.
Well, I would say as far as less compelling is when the founder of the company is demonstrating a lack of, let's call it coachability, unwilling to take advice. No matter how smart you are, it's always good to listen to the opinions of others. And when someone comes across with a bit too much hubris and a know-it-all attitude, it tends to be a turnoff for investors. And I can also point to many examples of where companies have failed for that very reason.
Yep, there's one. Who else has got something?
I'll talk about relationships because Irene brought it up. It's not just it's the relationships within the company. And this speaks to Mike's point too, of coachability. If we have a leader that's not coachable, very likely his team of people who report to him or her, the direct reports are not a cohesive too. So if there's a poor relationships between the major key players, the management, as well as on the board, that's a red flag, and we would definitely walk.
All right, I'm going to do Irene and then Hans.
Yeah, and maybe this is very clear for everyone that this would be a problem, but that is disorganization. And I mean that in the widest sense of the word. If I ask for specific information and the response is, oh, we're not so sure. If I ask for a 2-page executive summary and I get a 6-page executive summary, that goes back to coachability as well. But I think just being very organized and knowing what your plan is. We know reality always plays out a different way than we hope for or plan on. But I like people to have planned their way back to where they are now. And for me, organization is you can switch it around, is very attractive.
All righty. And
yeah, so 2 comments. First of all, I agree with the comments that have come before. I think those are good observations, and we all have our kind of case studies for some of those as examples. So my points, which are kind of they're connected, are when you run into a founder who has control issues, and this is someone who is just a control freak. They, as Mike says, sometimes they don't like to take advice. They get stuck on their valuation. All kinds of other indicators that really show that they often rather pejoratively view the investors as little more than sources of money, typically that's it's a bit of a warning sign. And having been through this now more than 2 decades, I can tell you the success rate of people like that, occasionally they pull it off, but the failure rate is much higher than it is for the more, let's say, personality balanced type CEOs who, seek a sort of a broader level of community input and take feedback from those who are more experienced around them. So, and then sort of an iteration of this, and you tend to see it during fundraising, which is why I raise it, is where people become completely obsessed about the valuation of their financing, as opposed to terms. It's remarkable. People will stick the number as opposed to, well, what else came with the number, but where they become so hyper obsessed on that it kind of transcends the entire transaction, and it almost becomes a point of principled ego, another warning sign for this individual when you're going through this process. And anytime you see that, I tend to think forward and kind of go, okay, well, what's this person be like the next time we're raising money? Yeah, they're going to be a fierce advocate for valuation, but they may, in a quest to optimize that, bring on a bunch of terms that are actually toxic to some of the existing investors, or as Mike said correctly, people who have yet to become investors, the safe note people. They're the ones who could get screwed if this person decides to peg on a high valuation but crappy terms that shaft the safe people when they're getting to convert it into to becoming shareholders. So so those are kind of different manifestations of sometimes the same kinds of issues. So anyway, so those are my comments.
Great. So I'm just going to ask Kaylin, I mean, you're a banker. Am I correct that incomplete paperwork or especially incomplete financials are a huge problem for you?
Yeah, I would say, but also, yeah, the angle I would go to is when we like to see plans for the funds, like to give it a banking, like a debt perspective. What is the funds going to be used for? What do you think they're going to do for the company? Like the angels and VCs here, they're going to go a little more, a little deeper, and they're going to help. They're going to add a little more value on the management side. So they're going to really care about the management team. Another thing that I see a lot that I would, to come from a totally different angle, is just trying to use the wrong tool at the wrong time, like trying to cram debt into a company too early, or not understanding who they're talking to. Like if you are talking to a Series A investor, to understand their portfolio, and then not to come in as a pre-seed company trying to push into a fund that maybe focuses on Series B or growth equity. So really maybe just doing the research before and knowing which tool, if you're ready for the tool that you're actually asking for, is what I would add. But maybe to go back on your incomplete financials, like we do need for debt, we do need to see like the last year's financial statements and interim financials. Those are going to be pretty standard documents, so they should be up to date and ready for the discussions.
Cool. Thank you. Jason, anything you'd like to add?
Yeah, I mean, a lot's already been covered. I will say that it drives our corporate finance group nuts when we get a drip feed of information. You know, you ask for 10 things and you get one, then you get two the next day, and then maybe another one the next day. It just creates such a bad impression. It would be better for the company to say, fine, thanks for these 10 requests. I'll be back to you in 6 days or whatever with a whole data room of everything that's been requested.
Alrighty, that's a good one. So one question that hasn't come up, or one comment, has been about IP. So am I correct? Maybe just a show of hands. If people have IP, but it has not been secured properly, is that a real red flag? That people find that, you know, it's in the public domain, or they've had contractors or something and they're not sure if the IP is secure? Is that something that is an issue for a lot of investors?
So you say the company doesn't own the IP?
Or they own it, but when you look at how they built their platform or whatever they're building, it was clear that they didn't have the proper agreements with contractors or other past employees. So there's a real question as to whether somebody else could claim part of the IP in the future. Is that an issue for you or for some of the others on the line?
Yeah, I think that would be a big problem.
Yeah. So yeah, I see hands, go ahead.
Yeah, so we've gone through a bunch of transactions selling stuff out of our portfolio over the last 18 months in particular. There's a really active pace, like one a quarter kind of thing. And every single one of these, you know, the IP is in some form, you know, an important component of the reps and warranties that the sellers sign up for. And I guess my comment is, depends really how key the IP is to what you're doing. If it's fundamental, or if it's in any way kind of central to what the product offering is, your technology stack, or those things, oh yeah. And it's one thing to be able to say you own the patent so you can prevent others. That's one thing, and there's a debate people can have around the necessity for having that nailed down. But there's something else that's actually equally important, if not more so, down the line, which is freedom to operate, which is, do you actually have the right to use this technology in the way you are proposing going forward without having somebody else come after you? And that's usually the area that comes up more when you're getting sold, where the buyer wants to make sure they're not buying this latent hand grenade in this box that you're handing them, that there's going to be an issue. So So I think it's an important, so put it this way, if IP is a central tenet of what your, what your strategy and what your, business and all that stuff is, then it's important to make sure you get this nailed down. There are other forms of IP like trade secret stuff that I don't think quite fall into that category. So I think it's important to understand exactly what use is being made of it. But it's important, and if you ignore it early, it's at your peril, because down the road, you'll have to face it at some point.
Okay, I'm just going to move on to another question, and I'm going to go to Mike first, because I think Mike is probably the earliest stage investor in the group that's here today. And say, how much progress does a company need to make before they can raise capital? I mean, we have a lot of very early stage companies in the audience at Vancouver Startup Week. A lot of them are still almost concept or just recently launched. Can you give us an idea of what sort of thresholds you're looking for?
Yeah, so thanks, Dave. We will invest pre-revenue. Sometimes we invest when it's really just an idea. But what I really look for by way of progress, I like to see a well-formulated business case. Maybe not a full-blown, 50-page business plan, but I'd like to see a business case. I find that a lot of startups have great difficulty in explaining exactly what it is that they're selling. And I like to hear that in simple terms. I like to see a picture or form a picture in my mind. This is the widget or the service or the product that is actually going to generate revenue for the company. So I want a really clear picture of that. And I want to see how that is unique and different. What is it that's going to attract buyers to that? And then ultimately, how is the company going to make money? And finally, how are investors going to make money? It's easy for companies to talk about their better mousetrap, but they sometimes forget how the investor is going to get a return. And that's important to articulate at some point. But in terms of progress, I think, two or three people in a company, 2 or 3 founders with a good case, that's what I look for as a starting point.
Okay, so team. So I think there's a couple of other relatively early stage folks here. I'm looking at both Irene and Thalzel. Would one of you like to expand a bit on what Mike has suggested, or is there something else that you would think is an important item for a company to have ticked off or to have made progress with?
Yeah, there's one thing that really strikes me as really odd and that builds up further to what Mike says, like that companies or founders do not understand the audience they're talking to. And that is in a very wide sense. The audience can put its money wherever they want to put it. So you have to have a really good case for them to be interested in you. And that requires a sort of figuring out who the audience is and adjusting your message to that. So I'm not an engineer and I will never be, but if you can explain to me in very common terms, as Mike said, what you do, I get the idea and my interest might be piqued. In the whole pitching process, there's like many points that people can switch off and do other things or focus on something else. So you have that moment and you have to make it work and be very aware of whom you're talking to and treat these people with respect as well. So don't waste their time and don't waste the effort.
Great, thank you. We've got about 12 minutes left. Is there anybody else that wants to make a comment on this question? I've got one more I'd like to put out there before we go to Q&A with the audience. Anybody else? Okay, final question I have is, Mike said he's looking forward to investing the rest of 2021 and also 2022. What do we think the market's going to be like? And I'm going to be a little bit of put out a suggestion is that we think there's a lot of money is coming to the marketplace for people who did not invest last year, and that there's a fair bit of money available, but it's going to dry up probably the next 12 to 18 months. So if you're looking to raise, do it now. Don't wait until late 2022. Am I correct? Am I dreaming in Technicolor? What do people think? Who's got an opinion?
Well, Dave, we don't know what's going to happen, right? We can never predict the future. Look at the last 2 years. Who'd have ever thought that things would turn out the way they have, not just with COVID, but in the financial market. So the advice that I would give is raise money now. If you've got a good story, this is the time. There are a lot of people out there. The valuations, as I mentioned earlier, are much higher now than they've been for a long time. There are a lot of new angel investors. You know, we've had a lot of healthy exits locally, and that has generated, I would guess, more than 100, that's probably an understatement, more than 100 newly minted angel investors who are all looking to take their windfall profits from their ventures and deploy them in new ventures, you know, giving back, supporting others the way they were supported. So this is a perfect time. And, you know, I was talking to a couple of companies in our own what if portfolio who are thinking of financing. And I said, do it, don't wait. You know, even if you think you're a little bit early, that doesn't matter, because you just don't know what's going to happen in a few months from now. So take this as a good time to go out and fill your war chest with cash to see you through what could turn out to be a downturn in the next few years.
Anybody else like to expand on that one or have a different opinion? Basil, can I put you on the spot?
Well, I'm with Mike. I mean, if there's an opportunity to raise money, certainly do that. I think what's happened in the last, over the last year with this pandemic, it's really exposed a lot of opportunities for businesses. And we're seeing that in the type of companies that have come across to What If, eFund, Vantech, Angel Forum. And I think the business models that have come through our desks these past several months during the pandemic really speaks to taking advantage of the opportunities that have been presented by COVID, and that's also for fundraising. I hope that makes sense.
Okay, thank you. Anybody else with a comment or suggestion? Jason, I mean, I know you're from Calgary. Are you bullish on oil and gas right now, or what's the situation?
We're not really in oil and gas at all. I think we've got a few tech service companies that are in there. I mean, I would always raise money when I can.
Okay.
I think that's what Mike said, and you know, I would never turn down the opportunity to raise money, because you just don't know how difficult it's going to be in the future. So as long as the terms are not overly bearing and restrictive to the company, I would keep raising capital.
Okay.
I think we have actually seen companies in our portfolio, and I think Telzel and Mike too can confirm that actually did a couple of financings or different tranches over the last year, way more than we've seen years before. So companies are doing that.
Yeah, it's hard work to raise money. So if for a period of time it's not so hard, I would jump on that.
Okay. Anybody else who's got a comment or suggestion? I know Vivian is online from Vancouver Startup Week. If there are questions from the audience, please feel free to bring them forward right now. Been looking in the Q&A, and at the moment I don't see questions from the audience.
Hi, so Janny here. We do have a question from the audience.
Sure.
The question is, we hear lots about what VCs want to see, but what do they not want to see? When evaluating a startup, what are the red flags VCs are looking for?
All right, I'm going to turn to Hans, as he is the true VC in the group. I think we've talked about a few of them, but are there things you would add?
Yeah. Well, I think, speaking for all VCs, which is hard, they don't want to see stuff that is outside the zone of what they're actually looking to invest in, either the stage, the sector, the technology, the market, or in some cases, geography. And it never ceases to surprise me how many investors come up and they pitch us, and you know, they haven't even looked at our website to understand what it is we do, our stage of investment, or any of these things. I mean, it's kind of elementary. Know your audience. You would be shocked to see how many times people are not matching their pitch to the audience. So I think that's an important one, and one of the easiest ones to fix. Just do your homework. Try to find warm introductions to the types of investors that are focused on feeding money to stuff that looks like you. Okay, that's one for sure. That's a biggie. Number two kind of follows on from that, and this will be the only other point I make on this, which is companies that are actually ready to take the capital from that particular investor. So even if you're early stage, you've got to have some level of the criteria that Mike or others here have talked about. When people come in and they're not prepared, you know, just like Irene talked about, or Jason in his comment about drip feeding stuff, when they're not prepared, it just makes the process a whole lot harder. And what companies often fail to recognize is that every one of these investors has multiple other things competing for their time. Existing investments, other prospective ones, other activities that really, you know, you're in a battle for attention against all of those factors. So you've got to come fully baked to the right audience in a way that's going to not just capture their attention initially, but manage to maintain it through your due diligence process and so forth. Because otherwise, you know, there's always another person pitching probably the next day. So those are my thoughts.
Okay. I know we've got about another 5 minutes remaining, and we don't have any more questions from the audience. So I'm going to do something which is quite unfair and just ask everybody what they think of the following markets. So maybe we'll just go show of hands. Are you excited by some of the markets that I'm going to name? So who's really keen on double-sided platforms right now? Like a double-sided market, consumer on one side, somebody else on the other. Not a winner. Okay. What about B2B software? B2B software is something that's busy. So Thalzel likes that. So does Irene. So we're getting a fair number of folks who are pretty much everybody sees B2B software as a positive step. And this is consistent with Vancouver. Vancouver has been a good B2B software town for a long, long time. A lot of quality people in that area. What about fuel cells? Who's excited by the potential for fuel cells long-term? So Jason, Mike? Yeah, I mean, again, one of the comments we get is that Vancouver is very, very strong in the fuel cell space. May not be quite as attractive a market if you're living in Detroit or somewhere like that. What about Bitcoin? Who's a big fan of Bitcoin? Who? Don't see any hands. Okay, okay.
So my favorite comment is these people talk about it as a store of value, and then the thing loses 50% of its value. It just in like 3 weeks. So yeah, no, sorry.
Okay. All right. So that's a negative. I'll take that. Fuel cell is yes. What about new battery or energy storage technologies? What do people think? So we're getting a pretty good show of hands there. Okay, that's a good side one. No. Who thinks cannabis is going to be a really good investment opportunity in the next little while? Okay, sort of silence is golden here. And IoT, or Internet of Things, and how this will change markets, or change or disintermediate a market, something like that. As people see this as a combination, yeah, I think everybody is sort of, in agreement that that is something that we'll see in the future, and more and more. Final one would be 5G. Is 5G really going to change stuff, or is it just going to slowly but surely seep into the marketplace?
I think the latter.
Yeah, slow. Thalza, what does that mean? I don't know. Yeah.
It means slowly seep into the market.
Okay, that's great. Good. Is there another market that I haven't mentioned that people are really keen on? Something that you're seeing a fair bit of and think will be important? Yes, Thalza.
It always amazes me to see the different technologies cross and intersect with each other. In the life sciences, which, where I invest quite heavily, I'm seeing a lot of AI being used to find new drugs and find, using computational analysis to find different ways of delivering quality healthcare to us. So it's the intersection of all these different technologies that they're not operating in silos.
Yep.
Dave, I don't think you mentioned robotics, and we're finding a lot of companies these days in that area. And
yeah,
what is already invested in, I think, 4 or 5 of them. And I think with the difficulty in getting labor to do, strawberry picking or whatever, or manufacturing, robots, I think are going to get more and more dominant, especially for repetitive tasks and even non-repetitive tasks.
Oh, that's a great comment. Thanks, Mike. And from somebody in the audience, NFTs, people think that this is something that we're going to see more of?
I think you see the previous comment on Bitcoin. That's
Okay.
just kind of,
Yeah.
this apples, yeah, no, like, I mean, there was a time when pets.org or whatever website went for like, some insane amount of money. And anyway, you see where that ended. One other comment, just on the double-sided marketplace, they're maybe not as attractive because they're really hard to do, and they're even harder to do well. So it's not that there's not an opportunity there, but it requires a special circumstance of the market, the person who's approaching it, and a bunch of other factors that are too lengthy to go into here. So I think it's one of these ones that in the right circumstances, and there's a company in BC that's doing some pretty interesting stuff that I won't name, but I think later this year people will hear a bit more about what they're doing and why it's working. And it's a double-sided situation, but it's hard. So it's not for everybody, and it's kind of, it's I think the bar for admission to be credible and even have a remote chance of success is much higher than it is in, let's say, compared to B2B, so.
Right. Okay. Thanks, Hans. A good comment. I think we're out of time pretty much, ladies and gentlemen. Any final comments from everybody? Could I just say, Irene, any final words, or Falza, we'll go ladies first.
Oh, you don't have to let me go first, but I happily go first. I think these are very exciting times. It's for the good and perhaps the bad, who knows, but these are good times. So it's exciting to be here and to be doing this kind of work and investment. So thanks for having it.
Great, Falza.
Yeah, I concur with Irene. These are very exciting times. There's a lot of money for investing in early stage companies, and that's always really encouraging. And there's a lot of entrepreneurs with amazing transformative ventures. And for me, it's the proof is in the pudding. Actions speak more than words. So it's not that the widget does what it says it's going to do, but there's actually traction in the marketplace with customers and or users. And I think that bodes well for the future of the entrepreneurs' ventures.
Great. Kaylin, anything closing comment?
Yeah, I think going back to the market trends, I think that I would add to those maybe like tools for creators, like the creator economy, something that's super exciting. And also a lot of e-commerce transition still actually happening, even though a lot of it happened during COVID. There's still a lot of e-commerce that we're starting to see happen, and pretty excited about that as well.
Great. Hans or Jason?
Well, I don't know about everybody else, but I'm just so excited to go to a physical meeting with people and see a physical entrepreneur pitch in front of me.
I will make a comment about that at the very end. We'll do that. Hans, how about you?
It's exciting because I think we're about to see a rebound effect from all the deferred purchases and spending and other activity that has been artificially suppressed over the last, well, it'll be 18 months by the time things start lifting. And, there's a pretty good argument to be made that there's going to be a fair amount of activity that is going to be pushed forward and is going to be superimposed on what would have otherwise been the regular activity, in, let's say, 2022. So my sense is that there may be multiple surprises to the upside in a couple of areas of the economy, including the tech economy and so forth, just because of that effect. So it's just to follow on with the other comments, it could be a very interesting time with some surprises in it. So should be one for the record books.
Mike, final comment.
Yeah, so for those in the audience that are wondering about how you might connect with angel investors. It's very easy. You see at least, well, 3 people in front of you where you can make that first step. So we've got Felzel with Vantech, Jason with the Valhalla Angels, and Irene with Angel Fund. So contact one of those 3 if you've never pitched to angels, and you'll find that it's a very friendly environment, friendly and safe environment. And I would encourage you to not procrastinate on that, but do it today and seize the opportunity.
Great. Thank you very much, Mike. And just wanted to come back to Jason's comment about face-to-face, and VentureLabs has a nice physical setting downtown. I haven't been there in a long time. I look forward to going there in person. One of the things we're going to do is move towards more of an office hours type setup where companies can make arrangements to come in and meet somebody. And as an open offer to everybody who's on this call, you're welcome to use VentureLabs once we reopen sometime in the fall. I know Mike and Falzel are there a lot, but we'd hope to see everybody else who's interested in coming down and joining us at VentureLabs, feeling free to use it as a good venue to meet early stage companies. So unless there's anything else, I'd like to thank Vancouver Startup Week and say we're going to wrap up now, and we'll look forward to seeing people with the other sessions we have tomorrow and Friday, and I hope that everybody enjoys themselves with all the different sessions that are part of Vancouver Startup Week. Thank you very much, ladies and gentlemen. Much appreciated.